Credit is easiest right before it disappears. Think about that for a second. The moment a lender is most willing to offer you money, the most attractive rate, the friendliest terms, the boldest pre-approved letter, that moment often sits right at the edge of the worst time to borrow it. And the scary part? Nobody tells you this. Not the lender, not the ad, not even most financial advice columns. So in the next 12 minutes, I want to explain exactly why this happens. Not as a conspiracy, not as a scary warning, but as a clear, mechanical explanation of how mortgage credit actually works, and why the timing of an offer tells you something very different from what it seems to. By the end, you'll have a mental model you can use every time you get one of those letters through the door. Let's get into it. Imagine you're renting, you've been saving, you've been watching rates, and then, one day, either on your phone or through the letterbox, something arrives. A mortgage offer, or a really good rate, or a pre-approved letter with your name on it. And it feels like good news, like the system is finally working in your favor. Here's what I want you to hold in your mind, though. Why now? Why does this offer arrive when it does? Is it because the lender has done a deep analysis of your future income security? Is it because the economy is in a healthy, stable moment where borrowing is genuinely safe? Often, no. The offer arrived because of a very different set of reasons. And once you understand those reasons, you start to see credit offers very differently. Here's the core idea, and it's counterintuitive. Your mortgage offer is a snapshot of the past, not a forecast of your future. Lenders mostly lend against what has already happened, your credit history, recent house prices, recent income patterns, recent default rates. They price their offers based on the world as it was, not the world as it's about to become. And that gap between the world as it was and the world as it's about to be is exactly where the trap lives. Let's break this down into 4 parts. Each one is simple. Together, they explain everything. When a mortgage lender decides whether to offer you money, and at what rate, they're working with historical data. Your credit score, built from your past behavior. The house valuation, based on recent comparable sales. Their default risk models, calibrated to previous recessions and previous borrower patterns. This is not a flaw, it's just how the system works. You can only build a model from data that already exists, but it creates a structural problem. When the economy is about to turn, when job losses are beginning, when asset prices are about to fall, that data hasn't updated yet. The model still says the world is fine because the world was fine 6 months ago when the data was collected. It's like driving using only a rearview mirror. You can see exactly where you've been, but you can't see the bend in the road ahead. One-line rule. Lenders are often lending against yesterday's economy. Here's the second mechanism. This one is less obvious, but it's arguably the most important. When the economy is softening, people often stop applying for mortgages. Volume falls. Maybe rates have been high. Maybe people are nervous. Maybe it's just a quieter period in the housing market. And when that happens, lenders get hungry. They still have costs to cover. They still have targets. They still need to write mortgages to make money. So what do? They compete harder for the borrowers who are still out there. Federal Reserve research has found something interesting here. When mortgage demand rises, lenders tend to raise their spreads and take longer to process applications because they don't need to fight as hard. But when demand falls, the incentive flips. Lenders narrow their margins. They market more aggressively. They send more letters. They make their offers look better. Banks that have eased lending standards, when asked why, have repeatedly pointed to the same reason: increased competition from other lenders. So the more aggressive the offer looks, the more likely it is that you're in a period where lenders need you more than you need them. Which sounds like good news. But here's the rub. When lenders are hungry, you look safer than you actually are. They're not lowering their standards because you're a better borrower. They're lowering them because they need the business. This is the part nobody explains. Mortgage underwriting, the process of deciding whether to lend to you and at what rate, is heavily driven by models. Computerized systems that take your inputs and spit out a decision. Those models are trained on historical data, past defaults, past credit behavior, past economic conditions, and they work reasonably well in normal times when the world tomorrow looks roughly like the world yesterday. But at turning points, when the economy is shifting from expansion to contraction, models can miss it completely. The signal in the data arrives late. Maybe unemployment hasn't risen yet. Maybe house prices haven't fallen yet. Maybe the defaults haven't started yet. New York Fed research on mortgage securitization has pointed to exactly this weakness, that backward-looking models can miss payment reset risk, the moment where circumstances change and borrowers suddenly can't keep up. The model still says approve, even though the conditions that made that approval sensible are already dissolving. One-line rule, the model may still say yes even when the answer should be wait. This is where it gets genuinely interesting, and this is the bit that catches a lot of people out. Mortgage rates don't just respond to how risky you are as a borrower, they respond to a whole range of market forces: central bank decisions, bond markets, global capital flows, inflation expectations. Which means this: rates can fall and offers can look more attractive even while the economy around you is weakening. The CFPB has tracked how dramatically this plays out in practice. The average 30-year fixed mortgage rate in the U.S. bottomed near 2.65% in January 2021, then climbed all the way to 7.79% by October 2023, then eased back to around 6.2% by late 2024. Right now, as of early 2026, Freddie Mac's weekly survey puts the average 30-year rate at around 6.4%. Each easing of rates triggered a wave of new offers. Each wave felt like an opportunity. But here's the key distinction. A lower rate is a market event. Your job security is a personal event. They do not move together. The offer can improve because money got cheaper, even while your own odds of trouble got worse. You could get a better-looking mortgage on a week when your industry is shedding jobs. You could refinance on a month when your employer is struggling. The rate tells you nothing about that. The lender's model may not catch it either. Now, let's put all four of those mechanisms together, because when you line them up in sequence, you get something that looks very familiar. Step 1. The economy still looks fine. Employment is holding up. House prices are stable. Recent credit history looks healthy. Nobody's defaulting yet. In the rearview mirror, clear road. Step 2. Mortgage demand weakens, so lenders compete harder. Volume drops. The housing market cools slightly. Lenders need business. They market more aggressively. They narrow their margins. Their offers look better than they have in months. Step 3. The offer arrives. You get the letter, or the rate comparison nudge on your app, or your pre-approved email. You still fit the model because the model was built on a world that still mostly exists, and the lender wants your business. Step 4. Reality worsens. The economic signals that were just below the surface start breaking through. Unemployment ticks up. House valuations get revised. Delinquency. Rates start to move. Funding costs for lenders rise. Investors get nervous. Step 5. Credit disappears. The same lender that was chasing you last quarter suddenly tightens, the SLOOS. The Federal Reserve's Senior Loan Officer Survey, which tracks how banks describe their own lending behavior, shows this pattern with striking consistency. Banks cite the same reasons every time: less favorable economic outlook, reduced risk tolerance, weaker collateral values, funding concerns. In one quarter, eager and competitive. Next quarter, cautious and closed. And here's the cruelest part of this sequence. The moment credit disappears is usually the moment households need it most, when the redundancy has come in, when the income is dropped, when the financial cushion has worn through. The easy money phase arrives before the hardship. The hard money phase arrives during the hardship. That is the trap. Let's talk about that letter specifically, because pre-approved is one of the most misunderstood phrases in consumer finance. Here's what it actually means. Lenders can purchase access to pre-screened credit data. That means they look at a list of people who meet certain basic criteria, a minimum credit score, say, and they send offers to all of them, in bulk, often millions at a time. The CFPB is clear on this. A pre-screened offer is based on information in your credit report indicating you meet certain criteria. But the offer is not guaranteed if you don't meet the lender's full requirements when you actually apply. In other words, the letter isn't a decision, it's an invitation to apply, based on yesterday's data, at a time when the lender needs volume. The mailer is early cycle optimism dressed up as certainty. It feels personal, it has your name on it, it says pre-approved. But it's a marketing document, and the timing of its arrival tells you more about the lender's situation than it does about yours. This is the part nobody explains, and it's where people make expensive mistakes. When you see a mortgage offer, you see a rate, maybe a monthly payment figure. What you don't immediately see, the total cost, the fee structure, the reset risk, if it's a variable rate, and how your payment changes if your income changes. The FTC is pretty clear on this. Knowing only the monthly payment or the headline rate is not enough. The APR, the annual percentage rate, is more complete because it includes fees, points, and certain other costs. Two mortgages with the same interest rate can have very different APRs, and the difference can amount to thousands of pounds over the life of the loan. If an ad shows you a rate, it's legally required in most jurisdictions to also show you the APR. If the APR may rise after closing, if it's a variable rate deal, it must say so. And then there's the payment risk question. This is where it gets really important. Regulators are explicit. Lenders generally cannot qualify you on a temporary teaser rate. On adjustable rate mortgages, they're generally required to consider the highest rate that may apply, the worst case, not just the introductory low rate. But that doesn't mean you are automatically protected from the consequences, because here's what the regulation doesn't account for. Your income may be fine today and squeezed tomorrow. Your employer may look stable now and troubled in 18 months. Your household may be able to service this payment in a benign environment and not in a difficult one. New York Fed research has found that cutting a required mortgage payment in half can reduce the delinquency risk by around 55%. That tells you something profound. The size of the payment relative to your income is one of the most powerful predictors of whether you'll keep up. A cheaper looking offer is not the same as a safe loan. Here's the shift in how you think about this. Most people look at a mortgage offer and ask one question: can I get approved? That's the wrong question. The better questions are, why is this offer arriving now? What does the timing tell me about where we are in the cycle? Can I sustain this payment if my circumstances get worse? Because mortgage offers are not just about your credit worthiness. They're also about where lenders are in the cycle, when the recent past still looks good, when competition among lenders is intense, when risk models haven't caught up. Credit looks generous, the offers flow, the rates seem reasonable, and that is exactly when the window may be closest to closing. Cheap money and safe timing are not the same thing. They can arrive together, they can arrive apart. The offer can't tell you which situation you're in. You have to look at that yourself. So, what do you actually do with this? Here are 5 things, none of which require a finance degree. 1. Compare APR, not just the headline rate. 2 offers can look identical on the rate and feel completely different once fees are included. A PR is the number to compare. Full stop. 2. Treat the pre-approved letter as marketing. It is not confirmation that this is the right time for you to borrow. It is confirmation that the lender wants business and you appear to fit their current criteria. Those are very different things. 3. Stress test the payment. Before you sign anything, ask yourself, what does this payment look like if I lose my job? If my hours get cut? If rates rise and I'm on a variable deal? If the answer makes you feel sick, that's information. 4. Focus on resilience, not just approval. The question isn't, can I afford this in ideal conditions? It's, can I handle this if conditions worsen? That means emergency savings, stable income, and not stretching to the maximum you've been approved for. 5. Shop multiple lenders. Pricing varies significantly. Getting multiple quotes costs nothing and can save thousands. The FTC and CFPB both make this point in their consumer guidance, and it's one of the clearest pieces of practical advice in mortgage finance. Here's the mental model I want you to leave with today. Loans are made based on yesterday. Payments happen in tomorrow. Lenders look backwards. Life moves forwards. And the gap between those two things is where the risk lives. When an offer arrives, through the door, on your phone, in your inbox, the question isn't just, is this a good rate? The question is, what is this offer telling me about where we are right now? Is demand weak? Are lenders competing hard? Does the recent past look healthy even as the near future might not? That's the analysis. And now you can do it. If this made something click for you, hit the like button. It genuinely helps the channel reach people who need to hear this. And if you want to go deeper on how banks actually create money when they approve your mortgage, that video is up next. See you there.